All right, today we're going to be covering the topic of understanding key financial statements such as P&L, balance sheet, cash flow, and depreciation. Why financial literacy matters for executive directors. One of your responsibilities will be fiduciary duties, oversee the financial health of the organization, donor and grant accountability, so track restricted and unrestricted funds and answer any questions that they might have for you. Board reporting, collaborate effectively with finance committee and auditors. The board is who you're going to answer to. They're going to be asking you questions as to why it's effective or why it's not, why there's big impacts, why there's not. Sustainability, so making data-driven decisions for mission longevity, keeping the function of the mission and the company on track for long-term services provided. Next, we have the statement of activities in nonprofit terms, or P&L if it's a for-profit. Same exact thing, different words, but same function, okay? So as you can see on the top, you have contributions and grants. Unrestricted means it's basically grants or money used for any project or any service provided. Restricted means it was for a specific service or project provided. Totals 200,000. Your program service revenue is 100,000, so your total revenue for unrestricted would be 250,000. Excuse me. Your restricted would be 50,000, and your total would be 300,000, as seen on the right, halfway down. So total revenue is all plus, right? It's all positive. It's all money coming in. It's all money that you have for certain services provided or projects. Program expenses underneath are all going to be negative. So everything above this line, the total revenue line, and the top three lines are all positive. The bottom three lines, program, management, fundraising, are all negative. Okay. So program expenses, 180,000. Your management and general expenses are 40,000. Your fundraising is 20,000, which gives you the remaining balance. If you minus total revenue, 300,000, halfway down, minus all three of the lines underneath it, you get 60,000 and change in net assets. Okay. What this does, it allows you to monitor the ratio of program expenses to admin and fundraising and see if you're effective, efficient, if it makes sense. Okay. Unrestricted, understanding of restrictions, temporary versus permanent restricted is net assets. Like I said, those are things to just kind of understand as you go. The next slide, we'll be doing the balance sheet. So the balance sheet will always equal, okay? If it does not equal, as seen on the left, you'll see total 180 for assets line, cash, grants receivable, furniture and equipment equals 180. Then you have your liability side, payable, deferred revenue, assets without restrictions, net assets without restriction equal 180. They both equal 180, okay? Always keep that in mind. That's accounting 101. They always have to equal. If they're not equal, then you have an accounting error issue problem, okay? So always bring that up to whoever your accountant is, CFO, whoever. But like I said, normal everyday function, it should be equal, okay? So what does this do? This equals your liquidity check. What is your available cash for operations? So right now you have $80,000 in cash for operation, right? So like I said, that's not great. It's decent because it's plus, right? You always want to have cash. Cash is king, no matter if it's for profit, not for profit, whatever. Always king. Always need to have cash. Okay. Understanding your net assets, your equity in the nonprofit world. So that is basically the importance of how you're gauged is through your equity, okay, which is your net assets line as seen on the right. Without restrictions, 90,000. With restrictions, 60,000. All right. Next slide, statement of cash flow. So this is basically going to be your cash from operations minus, as seen there, purchase of equipment equals grant advance deferred, which would be 10,000, and then your total net increase in cash is 20,000. All right. So your total cash from operations is 25,000. You always want to have that in your back pocket. You want to have that cash available to use whenever you need it, if you do need it. Okay. The purchase of equipment takes away that 15,000. So your total grant deferment would be plus 10, and then that would equal that $20,000 in net increase in cash. Okay. What this does, this is just basically the benefit of this report is to show it to the board and just show them basically that you have the cash in the bank. This is what you totally have. Your net increase in cash is 20,000. That's what you have available because you've used, like I said, 15,000 of it to purchase equipment. Okay. The surplus in the statement of activities is a positive cash flow. So that's good. You're still positive. The goal is to always remain positive. Obviously, you'd want that number to be higher if possible. 20,000, like I said, is not a big margin of error in case you need it. It's not a lot to be used, in normal cases. So it's better to have more if possible, obviously. Also, keep in mind any major donor gifts or grant delays can skew this liquidity, right? So say for example, this month you have a donor gift that's coming in at the end of the month. You haven't recorded it yet, right? So that might be, that might give you a grant of maybe another 20,000 or 30,000, depending on what the grant person wanted to provide. So that might not be accounted for at the time when this is shown. So you might have to make a note, in theory, if you're trying to present to the board or something, that there might be another impact that's not shown on this. Like I said, such as that grant amount that might be coming in later in the month, depending on when you present this. Some grant or some of your board members might want to see it, the first of the month or the 15th of the month. So like I said, so if you have that impact on the 25th, they won't see it till the next month. Okay, so like I said, it's just kind of an awareness issue, not a big deal, but it's something to be aware of. Okay. Next, depreciation schedule and capital planning. What is it, right? It's a method of allocating the cost of long-term assets over their useful lives. Common nonprofit examples would be buildings, vehicles, computers, theater lighting, etc. Straight line depreciation, how you would account for it is, say you purchase a van for 50,000, the lifetime use of the van is 5 years. So your annual depreciation per year of that vehicle would be 10,000. Now, depending on how intricate you want to get with accounting, you would basically amortize. Sorry, I cannot talk. You'd put it in an amortization schedule over the 12-month period, right? So it'd be a little bit less than $1,000 a month recognized as depreciation, or like I said, the annual impact of 10,000. However you want to do it, it equals the same thing, okay? But for your monthly, usually in a leadership role, you'd present that information monthly, so you'd see that that 10,000 across that line item 12 times, okay? Um, so what does that help with? So what depreciation helps with is anything in most cases, like I said, you'd have to ask the company you work for what their capitalization policy is. It depends on the company, because there's no requirement by GAAP, which is the general accounting principles for non-for-profits in this area. So usually though, in perfect functioning practices, you'd want to amortize things over $5,000, only because it helps with just recognizing that amount month over month. So like I said, 50,000 in this specific example for the van is a little high, right? So you wouldn't want to recognize that expense over a one-time period. You wouldn't want to see that $50,000 impact in a month, right? Because it's a lot of money based on the scale that we're working on. So you'd want to see that based, over a 12-month period over 5 years. So like I said, it's only $10,000 a year instead of 50 for a one-time impact. So it just kind of helps with your financial presentation. It just helps with keeping the cash flow, basically useful and not just spent out over 1 month. So that's the whole purpose of the depreciation. All right. And this line item would appear on your P&L sheet or statement of activity. So you'd see that on there. Like I said, it didn't show up on the example I presented, so I figured I would retouch on that just so you know where to look for it when you're trying to find it. Okay. So continued on here, the reporting impacts of depreciation, the statement of activities, as I mentioned before, depreciation is a non-cash expense. So it is an expense, it's non-cash, and like I said, you wouldn't want to recognize it at one time in a 1 month period, most likely. Okay, you'd want to do it over a few years, so that's the whole point of depreciation. That's literally what it means, okay? Statement of financial position is accumulated depreciation reduces asset value. The statement of cash flow added back into the net income and operational section. So that's where you'll see that impact. Why it matters to executive directors or people in leadership roles. It helps to budget for future capital replacements. So, like, say your vehicle's coming up on its use is going to be expensed. Say it's May of this year, it's going to be expensed out in June of this year. Okay, so that's just something to be aware of, that you're going to have that item expensed out. So you might want to replace it. You might want to see, if there's funding available for new vehicles or whatever it is. Say the van, for example, the $50,000 van is going to be expensed out. You want to, basically replace it with a new van and see, if the board will approve it and so on. but it helps with grant requests for equipment purchases, as basically I was just stating, and it avoids surprise financial shocks due to aging assets, right? So that's the whole point, is to monitor it, and then you'll know when you need to replace it, right? If it's an item that's replaceable or something that you need for future operations.